Welcome back to your weekly real estate market update with Pries Capital Real Estate. I'm Tina Pries, founder of Pries Capital Real Estate. Each week, our job is simple: cut through the noise, ignore the headlines that don't apply locally, and bring you the real story in the Myrtle Beach housing market, based on live, trackable data. And that matters right now, because January is when people start making decisions again. Buyers are watching rates. Sellers are testing the market. Investors are asking, is this the year we finally get a normal cycle? Here's how we'll frame today's update. We're going to look at demand first, what pending sales are telling us about the next 30 to 45 days. Then we'll look at pricing, whether the market is holding steady or starting to negotiate lower. Then we'll cover inventory, how much choice buyers actually have, and whether supply is tightening or loosening. And finally, we'll talk about the one variable that changes everything: mortgage rates. If you're a buyer, this is about timing, leverage, and negotiating intelligently. If you're a seller, it's about positioning, price, presentation, and credibility in a more selective market. And if you're an investor, it's about risk assessment, cash flow assumptions, exit timelines, and whether demand is expanding or stalling. All right, let's get into the numbers and what they mean for Myrtle Beach right now. As we kick off 2026, I'm hearing the same questions every day. Are prices finally going to calm down? Will rates give buyers a real break? Is inventory still a problem? And, maybe the biggest one, does this finally feel normal again? What I'm seeing in the data is a market that's moving toward healthier, not hotter. That's an important distinction. Healthier means more balanced decisions, fewer panic offers, and fewer sellers assuming they can name any price and get it. It also means buyers can take a breath, do inspections, negotiate repairs, and ask for concessions without feeling like they're going to lose the house in 20 minutes. But here's the Myrtle Beach twist. Our market is not a single story. Primary residences, second homes, investor-owned rentals, and condos with rising HOA and insurance costs all behave differently. So national headlines are rarely a perfect fit here. In 2026, I'm watching three things closely. 1. Whether demand actually improves as rates ease. 2. Whether sellers re-enter the market as the lock-in effect loosens. And 3. Whether affordability pressures keep buyers cautious even if prices stabilize. Now, with that big picture context, let's go straight to the demand pipeline, because pending sales tells us what closings will look like next. Let's talk demand, because demand sets the tone for everything else. Economists broadly expect home sales to improve in 2026 as rates ease and more listings come to market. And yes, the lock-in effect is loosening. Homeowners who were frozen in place by ultra-low pandemic mortgages are slowly being forced back into the market by life events, job moves, family changes, retirement timing. That's real. But here's what our local weekly data is saying right now. Pending contracts are at 331, and that's down about 23.6% year over year at the start of January. That matters because today's pending pipeline becomes February's closings. So even if sentiment is improving, the immediate pipeline is still soft. And the biggest reason is rate volatility. When mortgage rates briefly dipped toward the low sixes, around that 6.1% area, we saw a quick burst of activity. Then rates popped, affordability tightened, and demand faded again. Myrtle Beach buyers are extremely payment sensitive right now, especially first-time buyers and anyone financing a second home. What this means? Buyers, you can be selective, but you need to be ready when the right house hits, especially in desirable pockets. Sellers, the buyer pool is thinner than headlines imply, so you must and can't stress enough on the must, earn the offer with price and condition. Investors, don't underwrite a demand snapback without confirming it through weekly pending trends. Now let's go to pricing, because this is where people get emotional. They want a simple answer. Are prices going up or down? In Myrtle Beach, the more accurate answer is, prices are sorting, not crashing. The weekly median pending price is around $449,900, up roughly 4% year over year. But week-to-week bumps don't tell the real story. When you smooth the noise over a 3-month view, what you see is stability, not a slide. And here's why the market feels different. Today's buyers are hyper-selective. They're comparing floor plan, lot, view corridor, HOA, and insurance profile, especially in condo and coastal communities, plus upgrades, age, and future maintenance risk. That creates tighter spreads. It creates appraisal sensitivity, and it means deals often hinge on condition and concessions, not just the list price. This is actually a healthier environment long term. When wages rise faster than home prices, even briefly, buyers regain purchasing power and the market becomes more sustainable. What this means: buyers focus on value and terms like concessions, rate buydowns, repairs, more than winning on price. Sellers, comps matter more now. The market won't pay a premium for average. Investors, price stability supports long-term holds, but your margins depend on financing and carrying costs. Let's talk supply, because inventory is where leverage shows up in real life. Active inventory in Myrtle Beach is around 969 this week, and it's down roughly 4.2% compared to last year, and we're still not back to pre-2019 levels. So no, this is not a full buyer's market across the board. But here's the key. Even with fewer listings, the pressure buyers feel is lower than it was during the pandemic era. The days of writing offers instantly, waiving protections, and competing with 10 other buyers are largely gone. Buyers are taking their time. They're touring more homes. They're making fewer concessions. And sellers are learning, sometimes the hard way, that if you're stubborn on price, buyers won't even click your listing, let alone schedule a showing. This is what a balanced market looks like. Good homes still sell, but they sell because they're priced right and presented well, not because buyers are desperate. What this means: buyers, you can negotiate, but move decisively on the homes that are truly well positioned. Sellers, presentation and pricing are not optional anymore. They are the strategy. Prices need to be cut to meet the market, not chase the market. Investors, watch submarkets. Condos and HOA-heavy communities can behave very differently than single-family neighborhoods. Now the variable that changes everything: mortgage rates. Nearly every serious housing economist will tell you the same thing. Rates are the biggest lever in the market. Not because rates need to go back to 3%, but because even moving from 7% down into the low sixes materially changes affordability. A 1-point drop can bring millions of households back into qualifying range nationally. Locally, it can be the difference between we'll wait and we're writing the offer. This week, the 30-year fixed average is about 6.16%, and that's down roughly 11.1% from last year. That is a meaningful shift. It doesn't guarantee a surge, but it does improve the math for buyers, and it improves the motivation for sellers who need transaction volume. The caution is volatility. If rates chop around, buyers hesitate. And when buyers hesitate, sellers either wait or they negotiate. What this means: buyers, rate dips are windows. Be prepared to act when affordability improves. Sellers, don't assume rates will save pricing. Earn the offer with pricing positioning. Investors, underwrite conservatively. Insurance, HOA, and financing costs can erase returns quickly. Here's the bottom line as we start 2026. This market looks healthier, and that's good news. Prices are not crashing. They're stabilizing and sorting. Sales are expected to improve, but the pipeline today still shows softness, so we'll keep watching weekly pending data closely. Inventory is stabilizing, not exploding, and buyers have more breathing room than they've had in years. Affordability is improving, but it's not easy yet. And mortgage rates remain the wild card, trending better, but still capable of shaking confidence if they spike. If you've been waiting for a market that makes sense again, 2026 may be the year we finally get closer to that. Not perfect, not cheap, but rational. For buyers, it's a year to shop with strategy and negotiate intelligently. For sellers, it's a year to win with preparation. Price cuts are a must. You need to meet the market instead of chasing. Home presentation and credibility is a plus. For investors, it's a year to focus on fundamentals, cash flow, carrying costs, and submarket selection, especially around condos where HOA and insurance dynamics matter. At Pries Capital Real Estate, we analyze these shifts in real time and help our clients position themselves advantageously in every season. If you're considering buying, selling, or simply want to understand what your home is worth in today's market, we're here to help with data-driven guidance you can trust. Visit us in Myrtle Beach, or reach out directly for a personalized consultation. And if you want to stay one step ahead, sign up for your free Pries Capital Real Estate research account at priescapitalrealestate.com for weekly, hyper-local insights. Thanks for watching, and we'll see you next week.